In this accounting mini lecture, we're going to cover generally accepted accounting principles and the conceptual framework. On this slide, you'll see a summary of the principles, assumptions, and constraints under generally accepted accounting principles. In the next few slides, we're going to cover each of these items individually. Let's begin with revenue recognition. Under generally accepted accounting principles, we recognize revenue in the accounting period in which it is earned. We will recognize the revenue even if we have not yet received the cash. So as long as the company has earned the revenue, even if they're going to receive the cash in a future accounting period, we go ahead and recognize the revenue in the period in which we've earned it. Now, the matching principle, this is one of the most important principles in U.S. GAAP. The matching principle basically states that we are going to match our expenses against the revenues that they help to generate. This means that we want our revenues and our expenses to be matched within the given accounting period in which they occurred. This will give us the most accurate possible picture of net income. Full disclosure principle. This basically states that if information would be relevant to a financial statement user, meaning it could impact the decisions that they make, then that information needs to be disclosed to the users. When it comes to financial reporting, this information would generally be included in the financial statement footnotes, which will directly follow the consolidated financial statements. The cost principle. Under U.S. GAAP, we record transactions based on their actual historical cost. That number is verifiable, and it lacks some of the subjectivity that might be involved in other figures. Now let's look at some of the assumptions that we used. One assumption is called the going concern assumption. This basically means that we are going to assume, absent information indicating otherwise, we are going to assume that a company is going to continue to remain in business rather than assuming that they're going to go out of business next month. And this is important from a financial reporting perspective because if a company was going to, go out of business the next month or, within a couple of months, then it may be necessary to restate some assets to liquidation values and that sort of thing. So from a generally accepted accounting principles perspective, we have to assume that the company is going to be a going concern, meaning that they are going to continue operating indefinitely. The monetary unit assumption, this one is very simple. We're just assuming that we can express transactions in a monetary unit. For example, in the U.S., this would simply be the dollar. When U.S. companies report their financial statements, they are reported in terms of U.S. dollars. Okay? The business entity assumption. This assumption simply states that a business is separate from its owner. So let's say that a person owns a plumbing business, okay? If they were to generate financial statements for that business, we would expect to only see assets, liabilities, expenses, and revenues related to the business. We would not want to see personal assets of the owner or personal household expenses listed on the income statement or anything of that nature. It should only be business transactions that are reported, and that's a separate entity assumption. Okay? And the time period assumption just assumes that we can divide the accounting periods into certain time periods. For example, months, quarters, years. If a company is publicly traded in the U.S., they are going to be required to report their financial statements to the SEC at least quarterly as well as annually. However, for internal purposes, management would generally produce monthly financial statements as well for management review. Thank you for taking the time to watch this lecture on generally accepted accounting principles and the conceptual framework.